Hey everybody, it's Mike over at Taxes and Bricks. Welcome to episode 43. I think it's 43. Today we are going to talk about 529 plans. 529 plans. What are 529 plans? What kind of tax deductions do you get short term, like when you make contributions? What kind of tax breaks do you get long term? And when you withdraw money, and what happens if you withdraw money and you don't use it for what it's supposed to be used for? All of that and a little bit more, and some, I guess, for a sense of rarity. My personal feelings on 529 plans, not personal really, but more professional. Give an example sort of about what I do with respect to college savings for my family and for my kids, which I think is a pretty measured response and measured kind of way of doing things. But first, if you like this kind of content, don't forget to subscribe. Hit the like button too if you like what you hear, and share our content with your friends. Also, because this is tax and accounting related, I'm going to throw up a little disclaimer here and pay the lawyers, and we'll be right back. This video is rated TAX and contains occasional ramblings, mild attempts at humor, self-deprecation, irreverence, brief numerical examples, and adult tax and accounting advice that may not be suitable for all taxpayers. Viewer discretion is advised. Before following any of the advice in this or any of our videos, you should always consult with a tax professional. Thank you. All right, welcome back. So, what is a 529 plan? Well, a 529 plan, in short, is sort of a specialized, customized college savings plan. And there are kind of two main kinds of 529 plans. You've got sort of state programs, 529 plans that are they're not run by the government necessarily. Usually they're run by some kind of an investment company, but they're endorsed or sponsored by the state, or they're state qualified. And then you have private 529 plans. And what differentiates between the two is typically how they're treated short term from a tax standpoint. So ordinarily, sort of a state-sponsored or state-endorsed or state-qualified plan is going to allow you some short-term benefits, provided, of course, you're contributing to the state plan where you live, or your state will recognize the plan from another state. And there are some states that do that. The private plans typically do not come with any type of short-term contribution deduction, because ordinarily they're not state endorsed. So that is typically the difference between the two plans. So what's the whole point of a 529 plan? What's the purpose? Well, the idea with a 529 plan is that, right before, or maybe a long time before, or right after, or maybe during the course of having kids, or maybe not. I mean, some people do this for themselves, but most of the time you see it, it's parents doing it for kids, or grandparents doing it for kids. You open up a 529 plan. Every year you dump a little money in, and you just kind of let it sit, marinate, grow, invest it. And when the kids, or potentially yourself, but we'll say kids in this case, go off to college, you've got a nice little savings account there with the money that you put in, plus hopefully some earnings that you can tap to pay for college, or reimburse yourself for college fees and things that you paid for. And the idea is that in the event that you do take the money out and you pay for qualified educational expenses, you are permitted to take whatever you take out up to the point where you no longer have educational expenses, tax-free, both what you put in and the earnings. Okay? While money sits in the 529 plan and gets dividends and interest and capital gains, it's sheltered from tax, kind of like a retirement account, kind of like an IRA or a 401k, where you don't have to pay taxes every year if the account goes up in value, or the account generates some dividends or some interest or some capital gains or whatever. Okay. So what are the short-term benefits? Well, some states, most states, specifically states that have tax codes, but some states that have tax codes don't offer this, but most states will offer you a tax deduction on the state level for what you put into the 529 plan up to a prescribed limit. So we'll use Washington, D.C., for example. Washington, D.C., if you have a D.C. 529 plan or a D.C. college savings plan, as it's formerly called, you may put in up to $4,000 per person per plan, okay, and deduct that $4,000 on your DC tax return. And DC allows no more than $8,000 in deductions. So if you have, say, a husband and wife in DC, okay, or husband and husband or wife and wife, you have spouses, married spouses, and they have one child, each spouse may open up a 529 plan for the child, so you'd have two plans, and each may contribute up to $4,000 and deduct $8,000. You can contribute more. In many states and in many places, they'll allow you to put in more than whatever they allow for a deduction. But we're going to talk about why that might not necessarily be a good idea and why you might get into trouble in a second. Okay. $4,000 is kind of a magic number. A lot of states are at $4,000. Some are at $2,500. I believe Maryland's at $2,500. Virginia's at $4,000. A couple of other states I know are $4,000, but around here it's $4,400 and $2,500. Some states are like DC in the sense that they kind of cap the total amount that you can put in terms of a deduction. Some states will say, well, it's per parent, per plan, per kid. So if it's two parents and you've got 8 kids and you got 16 different plans, you could put in the max, and some states will allow you, more than just, an $8,000 deduction. Okay. So what don't you get when you put money into a 529 plan? Well, you do not get a federal tax deduction. I get this every year. Somebody will open up a 529 plan and they're new to it and they put the money in and they get their tax return, and then they call me up and say, hey, Mike, I was just looking at my tax return. I don't see my 529 plan deduction anywhere on my federal returns. And I say, gosh, me neither. Whoa, I must have screwed something up royally. No, the federal government does not allow a tax deduction for money that goes into a 529 plan. Only the states, and some states do. So you're not going to see a deduction on your federal tax return for money that goes into a 529 plan in the same way that you might see it for an IRA or a 401k. Okay? All right. So let's talk a little bit about what you can do with that money pre and post college. Well, a couple of years ago, the federal government passed a law that stated that actually you don't have to wait till college to tap your 529 plan money. Let's say you are paying for private school, parochial school, Catholic school, some kind of a private institution for your kids, K through 12. As a household, you can take up to $10,000 out of your 529 plans annually to cover or help cover some of the tuition costs for private school K through 12. Okay, so you don't have to wait until college to tap that money. Should you? No. You should wait as long as possible, because the entire point of a 529 plan is the longer it stays in there, the bigger the benefit on the back end. I mean, if you just put a bunch of money in when the kids are like 1, 2, 3 years old and you start tapping it when they're 4, I mean, you might as well have stuck it in something that probably would have done better from an investment standpoint than a 529 plan, because ordinarily 529 plans, they're not going to have the kind of robust returns that a normal investment or brokerage account might have. So just be aware that you're going to probably kind of handicap yourself a little bit in terms of taking that money out early. And so I don't advise it when my clients ask me to. Now, look, if you need the money, you need the money. I mean, far be it for me to tell anybody, don't touch your own money. It's your money. But just be advised, you can be kind of impacting future benefits and future tax benefits and kind of defeating somewhat of the purpose of the 529 plan. Okay, but let's say you're not going to tap that money while the kids are in, K through 12, and you're going to wait until they go off to college. So what happens, you send the kid off to college, get the tuition bill. It's like, 30, 40 grand, whatever it is, 50 grand. I don't know, however much college costs these days. And you pay the bill, or you you can sometimes direct money directly to the school from the 529 plan. So the bill comes in, it's like 30 grand or whatever it is. You call up the 529 plan company, and depending on, if your 529 plan will do this, they'll say, oh yeah, sure, just give us, XYZ information and we'll route the money directly there and make sure it gets there and the whole bit. Once you do that, though, you're going to receive a 1099-Q, as in Queen, okay? The 1099-Q does need to be reported on your tax return, but to the extent that you have educational expenses, it won't be taxable. So you're going to get this 1099-Q. It's going to say this is how much you took out of the 529 plan, and this is how much was what you had put in, and this is what was earnings, and all this other nonsense on there. And as long as you report that information, and then there's usually a place in the tax return, there's a worksheet where you can say, well, yeah, I took out 20 grand, but I also had 20 grand in expenses. Here you go. Okay. So what kind of things are covered in terms of allowed qualified expenses? Well, obviously tuition and fees that are mandated by the school, the university. Okay. Room and board. Okay. Room and board off campus. And this has been a debate. There are some schools of thought that say it's room and board off campus without exception. I don't necessarily agree with that. I've looked at a couple of things, and I think that the guidance pretty much says it's room and board to the extent that that's what you would pay on campus. So, for example, if room and board on campus is $20,000 or $5,000 or $10,000, and you decide to rent your kid a mansion for $150 grand for the year, that's not going to fly. Okay, if you're spending on room and board off campus a lot more than what the school would charge for room and board, you can't take all of that. Okay, so I always tell my clients room and board to the extent or close to what the school would charge for room and board. Okay, certain technology fees, certain fees that the school might charge for elective type things, like if you're in a lab or something, they charge a lab fee. I guess that's not really elective, but and then at one point, and I'm not sure if it's still like this, but certain technology that you purchase, which might be required or recommended by the school, so things like a laptop computer or certain devices or equipment, things like that. Okay. So what happens if you take you put money into a 529 plan, for years, and your kid doesn't go to school, kid doesn't go to college? Not everybody goes. I mean, gotta face reality. You don't know when your kid is 1 or 2 or 3. You can't tell me 100% that your kid's going to go to school. Okay? You can't tell me 100% that you're going to end up paying for it. I mean, your kid might invent the next Facebook or get a college scholarship for, being able to dunk a basketball better than anybody else in the country, or throw a football longer than Tom Brady, or, whatever. Your kid might end up, getting an academic scholarship, and then you don't have to pay. Your kid might get some grants or something like that. So what happens if you got this money sitting around in a 529 plan and you're not going to use it? Well, a couple things. Number one, you can change the beneficiary. It doesn't have to be your kid. You can change it to a grandchild, a niece, or a nephew. You can change it to a neighbor's kid. If you have another child or multiple kids, you can reallocate that money to them. Okay? Or you could take the money out and pay the taxes and potentially some penalty for withdrawing money from a 529 plan and not having the educational expenses to back it up. Okay. You could save it and hope that maybe if the kid goes on to school and gets scholarships or whatever it is, that maybe if they go to grad school, they're not going to get a scholarship, or you might actually have some out of pocket, and then you could save it for that. But I don't know, you might just be kicking the can down the road on that one. So, okay. Okay, let's talk a little bit about the over-contribution concept. I have a client, me, the financial advisor, on the phone with this client a couple of years ago, and we told him, because he wanted to put $250,000 in each one of his kids' 529 plans, all at once. He had a 3-year-old, a 1-year-old or something. He just wanted to do it all at once. He had a bunch of money. Good for him. Okay, and I said to him, don't do it. And don't do it. Financial advisor said, don't do it. He said, why? I said, first of all, you got a gift tax issue. Ooh, what did you say? A gift tax issue. This is not support. Money that goes into a 529 plan for a kid is not support. I mean, you can provide your kid with clothes and food all you want because that is support. You can pay out of pocket for tuition and medical and all of those things while your kid's living with you and you're dependent. And you can pay for all of those things. And that's not considered a gift because it's support. But money that goes into a 529 plan with your child as the beneficiary, even if you are the owner in that plan, that is a gift. And any gift that you give any individual, your child or anybody, over $15,000 for 2021, and I believe it's the same for 2022, you got to file a gift tax return. Does that matter? No. Is it a pain in the ass? Yes. Okay. Problem with this particular individual is when you give a gift, it starts to count against your lifetime unified estate credit. Okay. And it increases the likelihood that when you die, your estate's going to have to pay taxes. And if you think individual taxes are high, just wait until you're dead, because estate taxes are insanely high. Okay, and they don't just tax income that comes in; they tax the value of every darn thing you own over and above a certain threshold. The threshold's high, granted. It's, I think like 11, 12 million bucks, something like that. But as quickly as it got to 11, 12 million dollars, if the tastes and the flavor of the country change, it can drop back down to $1 million in 5.5 seconds. So I don't know that I would play that kind of game, and I don't know that I would do that, especially when you can accomplish what this guy was trying to accomplish without actually kicking $250,000 into a 529 plan. Here's what I do. Okay, every year I put the maximum amount that my state, Virginia, allows for a deduction into my kids' 529 plans. I got 2 kids. I got 2 plans. $8,000 goes in. Okay, I did the math. I figured between that and a little bit of savings or whatever, we'll probably be fine by the time the kids get to their freshman year to carry them through 4, maybe 5 years of school. Okay, after that, they want to go to grad school. They're on their own. Sorry about your luck. Daddy Mike's going to want to retire at some point, and Daddy Mike's probably going to want a sports car. So guess what? You pay for your own grad school. That's the way it goes. Tough luck. Okay, I might be heartless, but I think I'm doing my kids a favor, because if I deplete every dime worth of savings that I have, then my kids are going to spend a hell of a lot more money taking care of me when I'm broke than they would on a couple of years of grad school. So they're going to thank me in the end. I put a couple of bucks in the 529 plans. I let it sit. I invest it conservatively. And anytime I get any extra money, I just open up a general brokerage account in my name. Okay? And it's earmarked for the kids. So if we need it for college, or we need it for a car when they get their driver's license, or after school if we haven't used any of it, I could gift it to the kids in small batches so that they can, kind of supplement themselves after school's over if they get a job that they like but doesn't pay them all that well. Maybe I could help them with a down payment on the house, on a new house, something like that. That's kind of what my folks did with me. When I was early on after college, they gave me a couple bucks to do a down payment on a house, so I wasn't paying rent right after college and things like that. And I started, home ownership nice and early. So that's what I do. I mean, I get it. There are a lot of people out there right now that are shell-shocked because they're probably sitting on a pile of student loan debt, and they're freaked out because now they have kids and their folks didn't set them up for college, and so they're thinking to themselves, I'm not going to repeat the past. I'm not going to let history repeat itself here. I'm going to make sure that my kids go off to school with a giant fat sack of cash so that they never have to worry about student loan debt. And that's great. And you know what? Bully. That is awesome. But there's a way to do that and do it right, and then there's a way to do it and screw yourself. And I think over contributing to the 529 plans is a big risk, because if you have too much money in there, you're kind of locked in, or you're locked into paying taxes. And in the end, if you look back 20 years from when you started doing this with the 529 plans, okay, by the time you're done paying the taxes and potentially some penalty, and you look at the lost growth that you could have had sticking that money into a normal brokerage account that probably would have returned a little bit more money, okay, and you probably would have been paying some taxes all along on that, but who cares? Okay, you probably would see that you'd be better off just contributing modest amounts to the 529 plans. And then if you really want to turbocharge the college savings, open up some brokerage accounts in your name, have that money there. You can move it around. You get freedom and flexibility. If God forbid something bad happens, you've got access to money that isn't locked into a 529 plan. but you got some flexibility. God forbid there's a medical issue with you or one of your family members or something. You've got some money to tap. I mean, there's really no exception if you pull money out of a 529 plan because you've got some kind of horrible medical condition. There's really no exception. I mean, it's college or nothing. It's private school or nothing. And with the private school stuff, it's very low. It's $10,000. So anyway, that's kind of 529 plans in a nutshell. Obviously, before you open one or before you start to fund one, you're going to want to sit down with a financial advisor and discuss your options. You're going to want to discuss whether or not it makes sense to open a 529 plan in the state you live, or whether or not there are better options. And then you got to talk to a tax accountant about what you might be missing out on by not contributing to a 529 plan in the state you live. So all important stuff to kind of consider as you think about college savings for your kids and whatnot. So that's it for today. Thanks for watching. Again, like, subscribe. Don't forget to share our content with your friends, and have a great day. Hey everybody. So as I was watching and editing today's video, I thought about clarifying something about the gift issue. You can super fund a 529 plan up to $80,000 in 1 year, and not have a gift tax issue. So using an example, let's say I want to super fund a 529 plan. Maybe I'm delayed a little bit in starting it, or maybe it's a grandparent or something like that. I could put in up to $80,000 in 1 year into a 529 plan, and not have it count as a gift in excess of the $16,000 cap, say for 2022. The issue there is you still have to file a gift tax return. And what you would have to do is basically take that $80,000 and for the next 5 years file a gift tax return to show that you're essentially electing a 5-year contribution period for that contribution to the 529 plan. We see this a lot more with grandparents, where they'll put a bunch of money into a 529 plan for a grandchild. And that's fine. It's totally fine. But just understand that a gift tax return is a 709, mother of God, 709, still has to be filed every year for 5 years, so you can spread that $16,000 per year over those 5 years. There won't be any gift tax. But here's the issue. Grandparent, parent does this, there could be no more cash gifts to that child or that recipient. So if it's a grandparent tosses $80,000 into a 529 plan, that means no birthday money, no Christmas money, no Hanukkah money, no nothing. I mean, that's it. Otherwise, you've got an overage of gift tax, and then you've got a gift tax filing situation. So I wanted to clarify that, because I think when I was watching this, it wasn't clear. You can put in more than $16,000 into a 529 plan and not have it be a gift, but there are some issues with it that you'll have to deal with. So I just wanted to clarify it. I think bottom line is, if you're going to put in a fairly substantial amount of money, something close to or over the annual gift tax limits, you definitely want to sit down and talk to either a financial advisor or an accountant, just to make sure that you know what you're doing and you take care of whatever needs to happen afterwards. So just wanted to clarify that. Thanks for watching.